If you're an investor looking at TD Bank right now, you know exactly what I'm talking about. It feels like you're analyzing two completely different companies that have been mashed together into one stock. So let's get into it. This is the story of a financial giant at war with itself. And this is the big question, right? The one every investor is asking. Is TD still that rock-solid, dependable bank we've always known? Or is this disaster unfolding in the US actually the tip of a much, much bigger iceberg? That's the core tension we're going to unpack.
And this just lays it out perfectly. It really is a tale of two banks, clear as day. On one side, you have the Canadian fortress, a dominant force in a super stable, protected market that just consistently rewards its shareholders. And then you have the US quagmire. It's completely bogged down in this massive regulatory crisis, staring down billions in fines, and its entire growth plan is just frozen. So let's break down each side, starting with the good news. Okay, so if you're bullish on TD, if you think this stock is a buy, your argument has to start right here, in its home market of Canada. This is the bedrock of the entire company, and frankly, its position there gives it an incredible, almost unfair advantage. And that advantage boils down to one key concept: oligopoly. You see, Canadian banking isn't some Wild West free-for-all. It's basically a private club run by the big six banks, and because they control everything, they don't have to get into brutal price wars. It creates this super stable, predictable, and very, very profitable environment for all of them.
And if you want a number to grasp that dominance, here it is, 93%. The Big Six control a staggering 93% of all banking assets in the entire country. That isn't just a market share, folks. That's a financial moat. It's a fortress wall protecting their profits. And for an investor, that means reliable, consistent earnings from their Canadian business year in and year out.
Now, beyond that amazing market structure, the bulls point directly to the bank's own financial health. I know the term fortress balance sheet gets thrown around a lot, but in TD's case, it's actually true. The numbers really do back it up. They have a massive capital cushion to withstand pretty much any economic storm.
And the number that proves it is this one, 14.9%. That's their common equity Tier 1 ratio. Just think of it as the bank's ultimate safety buffer, its highest quality shock absorber. Regulators require them to have 11.5%. TD is sitting at 14.9%, which isn't just well above the minimum, it's the highest of all its major Canadian competitors. This is the number that helps investors sleep at night.
But all that strength, well, that's only half the story. Now we have to flip the coin and look at the bear case. And it is a big one. It's all centered on a catastrophic failure in the one place TD was supposed to be growing, the United States. The first number that just smacks you in the face is the fine, a jaw-dropping $3.09 billion US dollars. That's the price tag for settling charges over its systemic anti-money laundering failures. And to be clear, this isn't some small slap on the wrist. This is one of the largest penalties of its kind ever handed out to a bank.
But as painful as writing a $3 billion check is, that's not even the worst part, not by a long shot. The real killer for anyone investing in this stock is this, an indefinite asset cap. It means US regulators have basically put TD's American bank in a straitjacket. It is frozen. It cannot grow its assets, no big acquisitions, no major lending pushes, until the government gives them the all-clear.
And this is absolutely crucial to understand. The fine is a one-time hit. It hurts, but you move on. The asset cap, though, is a strategic nightmare. For years, the whole excitement around TD stock was its U.S. expansion story. That was the growth. Well, that story is now on hold, indefinitely. The growth engine has been shut down cold. So why did regulators come down so incredibly hard? Because these failures were just mind-bogglingly bad. We learned that the bank intentionally excluded over $18 trillion in transactions from being properly monitored. They went 8 straight years without adding any new ways to detect risk. And worst of all, this wasn't just about broken computers. Actual employees were found to be helping the criminals. And this quote, which reportedly came from an internal message at TD, it just says it all. Staff were apparently joking about watching money laundering happen in real time. That points to a deep, rotten cultural problem that you can't just fix with a software update. And that's exactly what has regulators and investors so worried.
Okay, so great story, right? A fortress versus a quagmire. But how does this drama actually show up on the bottom line? Let's connect the story to the financial statements.
If you look at their recent quarterly results, the story becomes crystal clear.
Their Canadian banking business saw income dip a modest 4%. Pretty stable, all things considered. But then you look at the U.S. retail segment. Down a sharp 13%. That's a direct result of all these new costs and the simple fact that they can't grow.
And this whole crisis is creating a huge drag on overall profitability. You can see it in a key metric called return on equity, which basically shows how well they generate profit for shareholders. TD is sitting at 12.3%. Its main rival, RBC, which doesn't have this U.S. problem, is at 14.7%. That gap right there, that's the cost of the crisis in plain sight. And the financial pain is far from over. The bank is telling everyone it expects to spend about $500 million every single year just on the cleanup, just fixing its broken U.S. systems. That's not a one-time cost. It's a persistent $500 million anchor that's going to drag on earnings for the foreseeable future.
Okay, so let's put it all together. We have the strong Canadian fortress on one side and the deeply troubled U.S. quagmire on the other. So how does an investor make a decision here? Well, it really all comes down to price and probability.
The market has already delivered a verdict, at least for now. TD trades at a price-to-earnings ratio of around 11.4 times, while its rival RBC is way up at 15.4. You see a similar story on a price-to-book basis. The market is clearly pricing in all this risk and lack of growth, making the stock cheap. The question is it cheap enough?
For an investor today, it seems like there are three potential paths forward, and it all hinges on the timeline. The bull case, they fix this mess fast, the asset cap is lifted in about a year or so, and the stock soars. The base case, it's a 2 to 3 year slog where the stock pretty much goes nowhere. And then there's the bear case, a regulatory nightmare that lasts 5 years or more, destroying even more value.
Which brings us to the final, ultimate question. We know the Canadian business is a cash machine. It's a fortress generating billions. Is that strength enough to pay for the cleanup and relaunch the U.S. growth story? Or has the damage in America been so severe that TD's best days of expansion are now permanently over? That is the multi-billion-dollar question that investors are betting on right now.